It is the 25 versus 50 debate. We are over just even odds for 50 basis points of a cut, which means congratulations, Fed. You will surprise the market either way you go. Stronger retail sales data and production led to 2 years ending the session by about 5 basis points higher. A little change this morning, up by 1 basis point. Meanwhile, equity futures are up 0.1%. At one point yesterday, we reached an intraday high. It ended the session little change, though the equal weighted version of the S&P 500 did end at another all-time record. Meanwhile, your euro versus the dollar, that is stronger 0.2%. 1.11 is where we stand on euro versus the dollar. So yes, it is 25 versus 50. I'm sure some people are looking forward to having that settled later today. Here's what some of the biggest market voices are saying about that debate.
25, 50 basis points.
25 or 50.
25 or 50.
It doesn't make a difference.
It's not going to be earth-shattering.
They're a long way from neutral, but I don't think they're going to do 50.
They're losing sense of the bigger picture. 25 basis points is going to be would be the right thing to do.
If they do 25, they'll lather it on pretty quick that they're going to do more later.
I always say we have a crystal ball, and at the end of the day, we'll see what the market does.
Let's add another brilliant voice to that mix. Adam Posen of the Peterson Institute writes the following. If they go 50 instead of 25, is it a big mistake? Probably not in terms of short-term damage to the economic outlook, but it does further undermine the Fed's communication. As you saw, Adam is with us now. Adam, thank you so much for joining this morning. So let's start there. Why is going 50 an issue of credibility?
I think, Dani, thanks for having me, and Fed Day. I think what's going on is we're seeing the culmination of months of the Fed shortening and shortening and narrowing the justifications they use for their decisions. So we've gone from a world where they were talking about a 2-year ahead forecast, which is what inflation targets generally do, and talking about multiple factors, to a world where in Chair Powell's Jackson Hole speech, he was talking just about the unemployment rate and just about the real Fed funds rate and just about the next 3 months. And so then you become what former Bank of England Governor Mervyn King used to call a hostage to fortune. So we got a unemployment number that came down last month. And even though it was totally expected that it would come down last month, everybody's like, oh, does that mean the Fed's changing? Does that mean the Fed's doing this? Does that mean the Fed's doing that? It never should have been so dependent on one piece of data. And so I don't understand all the drama, but I do understand that whether they do 25 or 50, the real problem is going to be how they say contingently, depending on how the economy goes, what are we going to do? Whereas what they keep saying is they're basically locked in, which I think is a mistake.
So what do you want to hear from Powell today, Adam, then, to clear some of this up, to get to the kind of scenario that you're talking about?
I don't think realistically we're going to hear it from him today. I think it needs the committee changing the dots or making a broader statement or having Powell read out a broader statement, which is not going to happen. And if they just say data dependence, that doesn't help, because the point is we don't know, or the Fed doesn't know, whether the monetary policy really is that tight. A lot of people are saying they're a long way from neutral. Well, they're a long way from neutral, but credit conditions are pretty darn easy, especially after the Fed raised 500 basis points. And the fact is, R-star, which is the benchmark, the abstract, unmeasurable benchmark for where policy should be in a full employment economy, has probably gone up. So the Fed policy is probably not that tight. At the same time, there are a lot of things going on in the labor market that are not just captured in the unemployment rate. So they would have to go out and go back to something like the way Yellen used to talk about a labor market dashboard, instead of just saying unemployment rate's going up.
To that point, you have a credit market that is still, spreads are really tight, as you mentioned. You have equity markets just around an all-time high. Just to get to the 50 basis point thing, the last few times we've had this, it was COVID, it was a credit market implosion, it was a stock market implosion, 2001, 2007, 2020. Does it set some different sort of precedent of what it means to do a big-sized cut? If that's what they do this time, is it a different transmission mechanism and response mechanism, rather, that we're dealing with from this Fed?
You're absolutely right, Dani. They would mean a different context, at least, and a different conditionality for what takes a big cut. Now, it's perfectly fair to say they raised rapidly so they can cut rapidly. There shouldn't be an asymmetry, but that means they have confidence in their forecast that they're pretty sure they need to cut a lot and quickly, and they haven't communicated that. And I don't think that's the right forecast, frankly. It might be right. I think you can argue this risk management, that inflation is on a downward path for the moment, and so the relative risk of being wrong on a recession versus wrong on inflation goes the way of cutting. But that's a different statement than saying, oh my God, we have to get cutting and we have to lock in the expectations that a year from now we're going to be down 200 basis points. And that's where I think the real problem is. They're so focused on the short term when there's no clear proximate cause of short-term problem, like you just said, which usually is the justification for a big, fast move.
I was going to say, Adam, is it a problem that we're even having this debate, that we're coming through a past couple days where we're talking about reading tea leaves from Colby Smith and Nick Timmeros, that we're trying to decipher things like retail sales to get an idea? Is it a problem that we're even at this point to begin with?
I think it's a reflection of an underlying problem. I mean, my personal forecast is they're going to do 25, and these news stories are going to turn out to have just been speculative news stories. We'll see. But the fact is, there shouldn't be this much uncertainty about what the Fed is considering. So if it is just the unemployment rate, and that was all, and the Fed funds rate, the real Fed funds rate, which was all Powell talked about in his Jackson Hole speech, then it's pretty straightforward, and it's weird that it's up in the air. If, on the other hand, as it should be, it's a more contingent, more nuanced forecast, then they have to explain why it's on this sort of tenterhooks and every little bit of data counts. This is not where you want to be as a central bank. You don't want to be having everyone sort of saying, what are they going to do next? I don't care if they disappoint markets. I don't care if they surprise markets. So, you know, in 2022, 2023, they surprised markets by continuing to hike when the markets were not expecting it. And that was the right thing. Listen to what I say, we'll keep going. But that's not what they're doing here. If that is what they're doing here, they should just go for it.
I say, if Powell can't be bullied, Powell & Co., by the 16th largest U.S. bank collapsing, then they probably shouldn't be bullied by a couple of bond traders trying to price in 50 basis points.
Well said.
Adam.
Well said, Dani.
Thank you. Adam, we were just talking moments ago about the Fed's decision today. I want to know about a month from now, when they'll have to make a decision the day after an election, and considering recent history, we might not even know who was elected at that point. What does it mean to be setting monetary policy around such uncertainty?
Here, I think the Fed has gotten one thing importantly very right and one thing not so right. The important thing under Jay Powell's leadership is they have said they're going to be the fair umpire. They're going to do the right thing for the economy irrespective of the election. Obviously, people cutting rates this close to an election, they are at risk of being accused of playing politics. I believe they're sincerely just trying to do the right thing for the economy. And so they're not going to be afraid. We were just joking about being bullied. They're not going to be afraid where there really is a bully to do what they think is the right call in November. Where I think they're missing a beat, and I wrote about this before Jackson Hole in the Financial Times and talked about it on Odd Lots with your colleagues, is that we know, whether it's Harris or Trump, that there's very likely going to be extremely further loosening in fiscal policy. And it's going to be much larger and more irresponsible under Trump than Harris, but either way, there's going to be a loosening. We know that whether it's Harris or Trump, there's going to be increased tariffs. Again, it's going to be much worse, much bigger under Trump than under Harris based on what they've said, but there will be additional tariffs on China and Mexico either way. So there is going to be inflationary pressures by the time we get to second quarter of 2025. And it would be good if the Fed, in a nonpartisan way, admitted that they cannot commit, as they keep seeming to do, to being on a long-standing path of easing through 2025, given these realities.
Adam, just to be clear, and by the way, that Odd Lots episode was wonderful. I think you used the phrase rifle shot to describe Powell's his speech at Jackson Hole, which was just perfect. But so just to underline what you're saying, whether it's Trump or it's Harris, are we going to be in a situation where mid-next year the Fed either needs to stop cutting or even hiking, regardless of who's president?
In my view, yes, with a high degree of confidence. I think if it's Harris, they'll have to stop cutting, and if it's Trump, they'll have to start hiking, based on what the policy statements and the party platforms are. And, I'm 65, 70% sure they're not going to do the 100 basis points currently priced in for 2025. Whether or not they're going to hike is contingent on whether Trump wins, but either way, I think it's wrong for the Fed to just pretend the future isn't going to happen. I think it will be right for them to reverse, but I think it would be good if they said in a nonpartisan way that possibility is there.
But Adam, I got to be honest, how do they actually do something like that? Because if they start talking about tariffs, people are automatically going to say, okay, the Fed is going after Trump with a presidential nominee who's already threatened the Fed's independence, not directly, of course, it's been according to reports, but there's already just so much contention over this issue.
I think Trump has directly threatened the Fed independence. It's not according to reports. He said he wants a say as president over monetary policy, which your Bloomberg colleague David Wilcox has written about, is a direct threat to Fed independence. But anyway, leaving that aside, this is why the Fed people were not happy with my writing or talking about this. Not that they care that much what I say, but to the degree they care. And I understand that their instinct is, let's just shorten the time horizon, let's just try not to offend anybody, let's just try to keep it narrow. But I think it puts them, all that does is move the awkwardness, so it doesn't in the end make things better. I think, and central banks cope with this all the time. Central banks in developing countries where the politics is what the U.S. politics, unfortunately, is increasingly looking like, largely due to Trump, is going to be much more uncertain, much more unstable, and the central bank has to be an anchor, and it doesn't fulfill its role as an anchor if it just sort of keeps its head down.
Adam, away from the Fed, we are in this period where you have a grab bag of policies being thrown out there by the candidates, from tariffs to deportation, and then from Harris, you have things like small business tax credits, promoting home building, supporting first-time home buyers. As you dig through the details, putting aside the likelihood of some of these things actually being passed, are you hearing anything that you think would be beneficial at this point in the cycle?
Oh, there's a lot out there that's beneficial. You were talking with Anne-Marie, I think, before I came on about the SALT deduction and some of these other things. And I don't know if either of you said it. I mean, Trump's like, the old Oprah joke, right? You get a car, you get a car, you get a tax cut, you get a tax cut. Harris is less so. I mean, it's a meaningful difference. But, the key question is, as Reagan said, as Biden said, is it spending to increase supply? Is it investment, or is it spending just for spending? Similarly, tax cuts. Is it tax cuts to increase investment, or is it just tax cuts? And that's the criterion you got to look through this. And some of the things that Harris is talking about continue to build up supply. There are a few things Trump is talking about that build up supply, but mostly not.
Okay, Adam, we're going to have to leave it there. Thank you so much for joining this morning. It is always a true pleasure to speak with you. Adam Posen of the Peterson Institute.